5 business days. That is what separates the silver market from April's first notice day at COMEX. And the data sitting underneath that countdown is unlike anything in exchange history. Curious, here is the current picture from the CME's own published reports. COMEX registered silver has declined 10.8% in the last 30 days alone, 9.6 million ounces withdrawn in 4 weeks. The coverage ratio, registered inventory against outstanding paper claims, currently stands at 14.2%. Below 15% is officially the stress zone. Paper leverage sits at 7.0 times. 7 paper claims for every single deliverable physical ounce. Size. COMEX registered inventory stands at 78.95 million ounces, a 67% decline from the April 2020 peak of 240 million ounces. At the current withdrawal pace, registered silver reaches exhaustion in approximately 182 trading days, roughly September 2026. That is not a prediction. That is arithmetic applied to daily vault data that anyone can pull from the CME website tonight. And April 1st notice day arrives in 5 business days, with 1,127 contracts representing 9.6 million ounces of potential delivery demand still sitting open. 5 days. 9.6 million ounces. 78.95 million ounces of registered silver left. This video is the complete picture of what that means and what it does not mean. Stay in. To understand why April's first notice day matters more than any previous delivery cycle, you need to see the drain sequence that preceded it. COMEX registered inventory has fallen from 240 million ounces in April 2020 to 86.13 million ounces by February 2026, a 64.1% decline over 6 years. But the pace is not linear, it is accelerating. In 2022, COMEX registered inventory was above 300 million ounces. Today it stands at 78.95 million ounces. March 2026 delivery cycle began with 52.63 million ounces in standing delivery demand against 88.78 million ounces registered, a 59.3% ratio that would have been considered a full-blown crisis in any prior cycle. And it is not just the Western vaults. Shanghai Gold Exchange inventory hit 10.24 million ounces, the lowest level since 2015. Combined COMEX and Shanghai drawdown over 6 years amounts to approximately 161 million ounces, representing 19.6% of the cumulative 820 million ounce supply deficit since 2019. Both the Eastern and Western physical silver pools are drawing down simultaneously. The arbitrage that should flow metal from one system to the other is not working. This is consistent with the hypothesis that both regions are drawing from separate, non-fungible supply pools. When the arbitrage between the world's 2 largest silver markets stops functioning, the paper price loses its connection to physical reality. According to goldsilver.ai's COMEX monitoring dashboard, which derives analytical metrics from CME's published data, the COMEX stress index stands at 84 out of 100 as of March 12th, near its all-time high. The same dashboard models a coverage ratio of 13.7% and estimates paper leverage at 7.3 times deliverable metal. These are third-party derived metrics, not official CME statistics, but they are calculated from the exchange's own daily warehouse reports, an 84 out of 100 stress score, built from 4 components: coverage ratio, inventory trend, paper leverage, and vault outflows. Not one component in the danger zone, all 4 simultaneously. Now the counter-argument that every serious analyst needs to hear. When delivery occurs on the COMEX, physical silver does not typically move. A delivery is a transfer of a warehouse receipt, essentially a warrant of ownership. The silver stays in the vault unless the new owner decides to withdraw it. That same warrant can change hands multiple times without a single ounce leaving the warehouse. The same silver can satisfy multiple delivery obligations through warrant transfers, explaining how monthly deliveries sometimes exceed the change in registered inventory levels. The COMEX maintains extensive authority to modify contract terms and settlement procedures during market stress, providing multiple intervention mechanisms that make defaults highly improbable. This is the most important nuance in the entire silver delivery debate. High delivery numbers do not automatically mean the vault is emptying at the same rate. Warrant transfers and physical withdrawals are 2 different things. What matters is when registered inventory declines without a corresponding increase in eligible, meaning metal is actually leaving the vault system entirely. In the latest month, registered metal saw a large down move. This metal did not flow into eligible, which stayed relatively flat. Instead, the metal left the vault entirely. That is the signal that matters, not the delivery number alone, but registered declining while eligible stays flat. metal leaving the system, not just changing hands inside it. The vault drain sits on top of a structural deficit that has been building for 6 consecutive years. The Silver Institute projects a 6th consecutive structural deficit of 67 million ounces for 2026. Total global silver demand running approximately 1.18 billion to 1.24 billion ounces annually against total supply of approximately 1 billion ounces. The dollar-driven pullback has a well-understood cause and a historical precedent. The precedent ends with the fundamentals reasserting. Here is the point that most analysis misses entirely. Lower silver prices do not reduce delivery demand from industrial users and commercial hedgers. They reduce investment demand. Industrial delivery demand is determined by production schedules, contractual requirements, and end-use needs, none of which are sensitive to whether silver is at $73 or $83. A price decline driven by investment outflows does not relieve the COMEX delivery pressure. Read that again. The paper price falling does not reduce industrial delivery demand. It reduces speculative investment demand. The physical drain continues regardless of what the paper price is doing. Now the positioning picture that makes the current setup particularly significant. Manage money longs. The speculative long positions in silver futures have collapsed from 54,115 contracts in February 2025 to approximately 12,240 contracts as of early March 2026, a 77% decline in speculative long positioning. The specs have been washed out completely. There is almost nothing left to sell on the speculative long side, which means the mathematical downside from further managed money liquidation is negligible. Simultaneously, commercial short positions have been covering in recent weeks. When commercial shorts cover and manage money longs sit at multi-year lows, the setup for an explosive re-entry requires only a single catalyst. If anything, lower prices can accelerate physical accumulation by opportunistic buyers, as happened in January 2026 when Turkey imported a record 273 tons in a single month. The investment sell-off creates the price decline, the physical market creates the floor. The bear case is real and deserves direct acknowledgement. The 52-week range on silver stretches from $29.11 to $121.78, a 318% spread. No other major commodity on the planet has a range that wide. That kind of volatility does not only happen in markets with strong physical fundamentals. It also happens in markets with speculative excess. The former JP Morgan chief strategist Marko Kolanovic has publicly argued the rally was a meme-driven mania, pointing to the 1970s precedent where gold surged dramatically, crashed 50%, then eventually ran to new highs. The paper leverage at 7.0 times deliverable metal means the paper market can continue suppressing price through cash settlements and margin hikes for longer than the vault arithmetic suggests it should be able to. The bullish silver case doesn't require chaos, it requires repricing. The case for higher silver prices isn't built on exchange collapse. COMEX has tools. Margin requirement increases, delivery procedure changes, force majeure cash settlement. It used those tools during the Hunt Brothers episode in 1980. It can use them again. And if the Iran conflict de-escalates significantly, oil drops, inflation expectations ease, the Fed finds room to cut rates, and the primary macro headwind for non-yielding assets reverses. That scenario does not change the structural physical thesis, but it would change the paper price in the short term. Size accordingly. Here is what to watch over the next 5 business days. COMEX Daily Warehouse Reports. Watch whether registered inventory continues declining. If registered drops while eligible stays flat, metal is leaving the system entirely, not just changing hands inside it. That is the genuine physical drain signal. The April delivery notices starting first notice day. As of March 13th, 9.9 million ounces of potential April delivery demand represents 12.6% of registered inventory. Before April 1st notice day, watch whether that demand accelerates or rolls into May. If it accelerates, the March stress pattern is repeating into April. If it rolls, the acute pressure is temporarily easing. The coverage ratio. Below 15% is officially the stress zone. We are currently at 14.2%. If it breaks below 12%, we are in territory with no modern historical precedent. The March 27th PCE inflation data. If it comes in hot, the Fed's one projected cut for 2026 gets pushed further or eliminated entirely. Dollar strengthens. Paper silver faces additional mechanical downward pressure. If it comes in soft, rate cut expectations partially revive. Dollar weakens. Silver catches a bid. 3 days until that number drops. Shanghai Premium Direction Daily. If the premium between Shanghai physical and COMEX paper widens further above $10, Eastern physical buyers are still absorbing Western paper selling. The paper price is wrong. If the premium compresses towards zero, arbitrage is functioning and the physical tightness is temporarily easing. Here is the complete picture as of March 24th. COMEX registered inventory at 78.95 million ounces, down 10.8% in 30 days. Coverage ratio at 14.2%, inside the official stress zone. Paper leverage at 7.0 times. April 1st notice day 5 business days away with 9.6 million ounces of potential delivery demand. COMEX registered at 78.95 million ounces and draining at 22 to 23 million ounces per month. Shanghai Gold Exchange vaults at 10.24 million ounces, the lowest level since 2015. Sixth consecutive structural deficit confirmed. Speculative longs washed out 77% from their peak. The paper price and the physical reality are telling two different stories. The vault data does not lie, the coverage ratio does not lie, the drain rate does not lie. Watch the 5 indicators over the next 5 days. Let the data tell you which story is right. Verify everything using the sources listed below. Invest with logic, not hype. Market Crux, signing off.